finally a company which has also been through the wars, but much smaller and much more local, and that is Lewis. Lewis Stores, of course, sells goods, furniture goods, televisions of this sort, kitchen utensils, kitchen outfits, cupboards, beds, that sort of thing. And they've got a variety of different operational brands, but Lewis is the main one. Market capitalization, 4.4 billion rand. Price to earnings ratio of 5.48, dividend yield of 11.31. That's if they continue to pay at that level.
Pay the dividend
but it's been under pressure because of the concerns around the finance charges and the insurance charges.
And all the investigations into that and the new legislation and the Consumer Credit Act and all of these changes are slowing South African economy. The consumer at probably the most financially constrained they've been since 2008. Look, they did buy a lot of stores, 60-odd stores from Allerines.
Exactly.
And they've integrated quite a few of them. And they are quite well diversified around the country, around the continent as well. But this is a truly difficult spot.
Because it was quite a well-run company. You're on insulin, and they're kind of conservative, got their own book, quite cautious, but then they got hit by the National Credit Regulator also for selling life policies, you know, and no, not only life policies to protect people from being retrenched, when in fact they were retired already.
Yeah, so there was clearly mis-selling there. And I mean, the whole industry is under severe scrutiny for these products. And I mean, how on earth you can actually sell that to a person now while your own internal controls don't pick it up? I mean, it's quite astounding, to be honest.
The industry, though, I mean, JD is off the market because it got slurped up by Steinhoff and reorganized. We know Allerines is out, so this is in fact the only way. So if you thought that there was at some point a revival.
Look, this is very similar, I suppose, to the low-cost airlines or the chicken industry. You get this thing at the right time in a falling interest rate environment with job growth, and that these shares can perform well. So when you look at it, 5p, it just looks damn cheap. I mean, it just looks really, really undervalued. But you're going into a rising interest rate environment, consumer under pressure, no job creation. So that cycle can turn. And I think it's going to turn quicker than what people anticipate, but not for the next year or two. So I think you can sit back on this one.
We'll go not on that one.